Well, good evening and welcome to this live stream on the 10th of November 2020. This is in the pre-show mode, so I'll just wang that on. So we're just waiting for a few more people to come on. Of course, always some stragglers. Hi, Cookie Boy. Hi, Michael. Good to see you there, Chris. Also putting stuff on the comments as well, so we know Chris Bates is in the room. I can confirm, I can see him. I'll bring him in very shortly once we've got started formally. And good to see some regulars come back and a couple of new names as well. So it's great to have you on the show tonight. A lot of things to talk about. Property is really moving around. Chris actually put some notes together, and looking at the length of the notes, this could be an 8-hour show. So it'll be very interesting. There's so much to talk about, so many changes. And you may remember, those who are long-time followers, that Chris got chopped because the NBN dropped here last time he was on. So I felt I owed him a whole show rather than half a show when he was in mid-flight, when he was taken off. So that's all good. I'm just going to run this for a little while longer, and then we'll get going. Lots to talk about tonight with regards to the markets and what's going on, particularly I think with regard to low interest rates, and also the impact with regard to the different types of property that's out there. And we'll talk about property dogs and property stars. That was something else we just started to talk about, and then got cut, so we didn't get very far with it. No, we're not doing any postcodes tonight at all, so I don't have my postcode tool connected, but we'll come back to that another day. Always plenty of discussion about the mortgage stress data, but not tonight. We're going to go into other areas. Okay, I'm just going to run this for another 30 seconds, and then we'll get going and start the conversation formally. And good to see some more people coming on. What tricks do realtors do to hide a dog, says Yogi Bear. We'll talk about that. And I guess the interesting question is, does a dog of a property always stay a dog of a property, or can you make it into a star? So we'll perhaps discuss that later. Okay, let me take the pre-show off. Going to put the intro on. I'll be back directly after. Hang on. Well, good evening and welcome to this live stream event on the 10th of November 2020. Martin North from Digital Finance Analytics here. Great to have you on board, and terrific for you to spend some of your evening with us. We're going to have a very interesting conversation. I have Chris Bates queued ready to come in a moment or two. I just want to cover, as I normally do, a couple of quick points before we start, just so that everyone is on the same page. We don't offer financial advice in this show. This is our opinion. This is based on our data, but it's not tailored financial advice, so please don't take it as such. Please play nice in the chat room. It's being moderated, and we will turn people off if they get antsy, so just bear that in mind. This is out at the 10th of November 2020. If you want to get my attention, use @WalkTheWorld. There's always plenty of stuff going on in the chat. I won't necessarily see it all, so that's a good way of making sure that you do. And I've also enabled Super Chat, so if you want to make your question hit the top of the queue, that's a way of doing it. You can also make a direct donation to Digital Finance Analytics and Walk the World, and help cover some of the costs of making these types of programs. Anyhow, without further ado, let me push a couple of buttons, and hopefully I can get Chris Bates in. Chris, are you there? Hey, welcome, and thanks for coming back after being chopped last time. yeah, I know. And no. Let's hope we get the full effect. And the point about this is that the conversation about property is always quite interesting and variable, right?
Yeah, I mean, I think when the responsible lending potential changes came through, I just sent you an email. Like, I can't remember what the acronym I used, but it wasn't probably a what's the word? Socially acceptable. But anyway, yeah, that was a huge change, and it's always changing. Obviously, the RBA change last week was is interesting because it's just changed a lot of the long-term rates and perception and attitude and appetite for debts. Probably we've already seen a shift in a week, and so yeah, lots we can talk about. So the floor is yours, I guess.
Yeah, indeed. And I should explain, for the first 10 seconds, I forgot to push one of my key buttons, and so there was no sound from you. So we've flushed a few people out saying, sound, sound, sound. So it's now good. Hopefully everybody is listening to you fine. And Chris, there is just so much to talk about tonight. I guess what I'd like to do to start with is just touch on this responsible lending stuff, because I think it's just so critical, right? In the scheme of things, I mean, both you and I were a bit surprised when it came out, although you could argue that it was always probably a bit of a sort of a quid pro quo between the banks and the government, right? And of course the government is very pro banks and the banks have very significant leverage. But the whole concept of switching responsibility from banks to individuals and putting all the pressure on individuals seems to me to be a very, very weird way of thinking about lending. And interesting, of course, McKim in the Senate today passed a motion, Greens motion, basically saying they want to stop this change to the legislation. So they tabled the legislation last week. I've been reading it. It's quite a long, boring read. But it is a very significant issue, isn't it?
Yeah, I mean, there was the whole battle with Westpac and ASIC that went on for almost probably a couple of years. I actually don't know how long it went for, but it went for a long time, back and forth, appeals. A lot of that was around, where does the responsibility lie? The banks freaked out through the Royal Commission because they said, well, hang on a sec, if people default on these home loans, are we going to be liable for that? We're going to have to foot the bill. And I think that case was huge for them to get their confidence back to lend. But, they're probably still whinging in the background to the government saying, it's still too tight. We don't know where the rules lie. And someone's obviously got in the ear of, the Liberals, and they've kind of said, well, why don't we just change the responsible lending rules and, put it back on the borrowers? And what we've already started to see, and we were seeing it prior to the change, is that the banks were starting to do a little bit less forensically looking at living expenses. We don't want to see those statements. We're not going to go through it line by line at the same sort of level. And so, I think that's probably the main thing that they're trying to go back to like it was probably, where, banks weren't looking at living expenses at all. They were just using customer declared living expenses. And the banks probably just want to go on like a higher HEM model where everyone's got a certain declared income, and then the way they manage the risk is like a multiple of income. So something called, debt to income ratio. So yeah, it's a very interesting change. I mean, it doesn't really change anything in my world, really. It's really, we're still doing the same thing, but what it potentially could create is a two-tier market where, you go to a broker who potentially will have this higher level of standards that's going to get introduced next year, which is something called best interest. But if you go to a branch and you go and see a bank home loan specialist or a personal banker, are they having to follow the same rules? And you could create this, potentially a lot easier access to credit through the banks and the branches, which ultimately is what the banks want, because those loans are a lot more profitable than the loans they have to, do that are introduced via brokers.
Yeah, no, that is very interesting, Chris. And of course, the other thing that we've now got is the APRA framework for lending, portfolio management, which is all about risk, right? That's now stronger than it was. So that's actually going to have some structured control on what the banks can do. And then we had the ASIC over on the other side. My view is this was a fundamental fault line between APRA and ASIC that's been there for a long, long time, right? And what the way they've solved it is basically to turn off ASIC pretty much with regard to anything to do with lending.
Yeah, exactly. And I mean, ASIC's, kind of been proven that they were a toothless tiger. Really, they couldn't do anything. They were, they did everything they could to, lift the standards around the responsibility of banks in terms of when they look at, applicants for credit, making sure they can afford it. But then, the courts just said, no, they don't need to do that. And then to make it kind of set in stone, the government's saying, well, no, we're just going to change the rules, and banks, it's not up to the banks anymore. It's up to the borrower. And if the borrower, takes on too much debt and they buy a poor property and they lose everything, well, that's their fault. It's not the bank's fault for for lending the money. And it is I personally do think that, there needs to be some form of protection, especially when people are making life-changing financial decisions, and if they do make a wrong decision, which is very easy to do, whether it's buying a poor property or whatever it is, there needs to be some type of way of protecting people, I think. So I'm not a massive fan of the change. I think it's, why do you need to do it? But ultimately, we all know why they're doing it.
Yeah, a bit more lending, a bit more keeping the prices up. But the point is, there are some people who are able to make rational decisions and probably can own the information that they actually provide to the banks. But there are many people who won't and may well end up over their heads. And now, of course, the responsible lending means that they do have some responsibility. The banks have some responsibility. They won't have responsibility. So essentially, if you want to get in over your head, it's down to you, right? And that is a really significant concern. And that's why the consumer advocate groups have been saying, oh, hang on a moment, there are people who are going to need more protection than this, because otherwise we're going to end up with a lot of big debt later. And people have been drawing comparisons between what happened prior to the global financial crisis in the US, where we ended up with this massive bulge in subprime loans, because basically anybody with a pulse could get a mortgage. And of course, it's concerning if you think that's actually underpinning it, because, yeah, sure, you can actually lend more and, try and keep prices higher and increase the size of the bank's balance sheets. But if in the process you're ending up with thousands and thousands of people who are into loans that they will never be able to service, I don't see how that can be good for anybody, and certainly not good for the banks, but also not good for the country. Yeah,
the problem with credit or home loans per se, just focusing on that part of it, credit cards and Afterpay, you could go, payday loans, all that sort of stuff are dangerous. But if you just focus on the home loan sort of part of the market, ultimately they're doing something with that money. So they're buying a property, and the property market is unregulated for a reason. And you got a lot of sort of spruikers out there trying to push people into new property. The state government's trying to do it, the federal government. And so there's lots of ways people can stuff up. So they can go and borrow this enormous amount of money. They put every single dollar they've got in there. And so that's why I think you need a little bit of extra protection, is because, there's no protection once they got that money. And so, a little bit, yeah, it's just a dangerous minefield. We saw it with self-managed super funds. Like, I've never been a fan of gearing your super fund into property, but back in, say, 2014, it was all the rage. Like, I remember going to a home buyer expo, and every single kind of sort of stall was offering SMSF loans and SMSF property. And, there's a huge problem that was building, and, glad they've kind of shut that down. You can still do it, but it's nowhere near as a level as you could do it. The same as just investors more generally. I mean, Martin, you'd see it in your surveys that the investors would say 3-4 properties. The standards they could borrow in 2014 were dramatically different to how they can borrow today, which is a good thing, because back then you could borrow, 10, 11, 12 times salary. Like, I've got clients that I remember doing the numbers and going, wow, you can borrow $3.5 million and you're on 300 grand a year or something, right? So that's not the case today. And I think that's a good thing. So you don't get these sort of property moguls sort of just, building big portfolios with zero chance to service that if it went off interest only, which is what happened in, the 2015 to 2018 sort of interest only sort of blitz.
No, that's absolutely right. And what I find interesting about that is that, you don't know how bad it is until later, right? So basically you can turn the handle and print the loans out and, inflate the balance sheets and home prices. It comes home to roost sometime later. And for example, in Western Australia, there was a huge boom 8-9 years ago, right? And it's still working its way out. If you look at some of, for example, Genworth's default information, they're still highlighting some of those loans that were made in Western Australia 4, 5, 6 years ago. So it tends to be a bit of a long, slow grind. And that's because people generally will do all they can to service their loans and, restructure and refinance as best they can, because they don't want to walk away. And of course, in Australia, there's full recourse as well. So all those factors are in play, which does make it a really interesting question, because it's almost a bit like, you sort of clamp down on the virus and you hope that a bit later you see the improvement, or you open up and then a month later you start seeing it's the same sort of thing with property. You can change the parameters around lending, but it doesn't necessarily mean that the next day you see the results, right?
Yeah,
it's baked in.
Those people in Perth, I've seen plenty of those clients, and they've, potentially the property's down 30-40%, or maybe it's come back a little bit as well, but they're going to lose $50,000. Now, no one wants to sell that property because it crystallizes that loss. It's extremely painful. They've already lost that money, but they don't want to kind of deal with it and have to put that loss against another property. So they just hold it. And so what you're doing is you're wasting opportunity of what you could have done with that borrowing capacity. You're going through the stress. You're thinking about it all the time, etc. So there's all these sort of knock-on effects that happen years down the line that you've got relationships, divorces, all these sort of things, health, that deteriorate over a bad property decision. And and it's unfortunately it's all unregulated, and that's one of the biggest problems is people can get themselves into this mess because no one's there to stop anyone.
Yeah. Now, one of the questions that Cookie Boy's thrown out, there's a few which we'll go through, but one which was very interesting is, have you been involved in any mortgage deferral conversations?
Yeah, plenty. We've got quite a lot of self-employed clients, and a lot of them had no idea what was going to happen over the next 6 months. Back in sort of March and April, the banks pretty much gave deferrals to anyone who really wanted one. Like if there was, you're thinking hundreds of thousands of customers asked for them. So they had very little sort of, it was all basically an auto sort of approve. The new 4 months deferral though, they are calling, and if they don't speak to you on the phone and get a valid reason that they're confident that you're going to be able to pay in the future, they'll force you back onto sort of repayments, etc. So that's a bit different, the 4 month versus the first 6 months. Ultimately, there is a bit of a problem with people who have gone on deferrals and then wanted to borrow more money or refinance or do a renovation, etc. You can't do it if you're on the deferral, which a lot of people who took the deferral and probably wish they didn't take the deferral, it's kind of come back to bite them a bit. But it's not so much now. And no one's really asking for it now, but it was very common, March to June sort of thing.
Well, I can tell you from my surveys, about half the people who got the deferrals didn't need it.
Yeah. There was no checks. The same as the super, and we've spoken about that here before,
Yep.
Who knows what percentage of those really qualified, but we know that was not the plan. There was always a cash grab.
Yeah, absolutely. And people have actually taken the advantage to stash some funds away. That's one of the reasons why the savings ratio is quite a lot higher than it was. But the superannuation withdrawal was a much bigger contribution to that relative to the loan deferrals. The other point I'd make is that my data is suggesting that some of those people who have been given a further extension, so there are people who've been given an extension, right? Some have got switched on to interest-only loans as a sort of a halfway house to try and sort of get some returns. Others were just given an extension. And so they've basically been said, we'll give you a bit longer, but also you may want to think about putting the property on the market so that you can actually, extract yourself in an orderly fashion, because the fact is that their incomes have been permanently damaged, so that they're not going to be able to get the employment they had, the income they had before. So that's given everybody a bit of a leeway in terms of being able to manage it. And CBA said we won't do anything until September, right? Well, of course, the point there is that if you start a foreclosure process, it normally takes 9 months to a year to follow through. So they're not really giving much out, I don't think.
Yeah, I think the CBA is a very interesting one where they're trying to get, written off by APRA so they can literally just have it extended almost, for another 6 months, let's say. But, who's to say in September they don't ask for another 6 months? And so, if you were working prior and you had no problems with your repayments and everything was fine, you could just say, well, I still haven't got another job. Why don't they just give you another 6 months? We've spoken about this before, Martin. The banks don't really care. If you've got equity in that property, it's a good asset.
Yep.
They're still getting the income from it. They're just building up a debt base. So, they're not worried about the capital value. Now, this is not across the whole, sort of market. But if they're in areas where you're almost getting close to negative equity, a lot of new house and land packages, a lot of new apartments, they're more likely to be close to that negative equity because it's a lot of new purchases. And so if a house and land package estate all sold in 2018, 2019, most of those will have 80-90% mortgages, much higher percentage than, say, in more established areas. So that's where the banks are more likely going to be saying, hang on a sec, are you really going to be out? Because we don't want to have to sell this in a fire sale when everyone else is doing fire sales. And so they're more likely to put pressure on you to kind of jump ship if you can, rather than the more established areas.
And the point there also, of course, Chris, is that APRA were very kind and basically gave the banks a free pass. So if they actually do a further 4-month reset, they basically reset the count. So that loan is not defined as bad.
Yeah.
So it is a way of keeping the real situation artificially suppressed when it comes to what really is going on with bad debts. And I don't know whether you saw, but Gemworth in their recent announcements in the last quarter made the point that they are finding it very difficult to get a clear read on what the real risk profile is in the mortgage sector, because the information just isn't available now.
Yeah, it's interesting. So you go on a payment holiday, but if you can't do the payment holiday, then they'll go interest only at 2% interest rates, which is probably cheaper than what you'd be paying in rent. And that's the thing, $1 million loan, let's say, is $20,000 a year of interest. But, you'd be probably paying $600-700 a week if you wanted to move out and rent something. So this is where it's, if you can keep those rates low, then maybe you stop people, even if they haven't got the same amount of income. Their repayments has fallen dramatically because they've gone from, principal and interest to interest only on 2% interest rates. And so, I think that the whole payment holiday thing, it's hard to really know. And that's what Gemworth is saying, is because we don't know who really needs it. We don't know if how the economy is going to recover in terms of how fast, etc. So, but it's what really matters about this is where is this going to hit harder than others? Like, where is the stress, which is what your mortgage postcode thing is, not evenly across the board.
No.
And if you own properties in those areas, you just got to be aware of this risk that's potentially brewing, that's kind of getting kicked down the road. Or if you're thinking about buying, you need to know where these areas are. So what areas could have problems in the next 12 months, right? Well, it could be a lot of new house and land packages, obviously the apartments, etc. So it's always about kind of getting the insight, but what does that actually mean for me is the most important thing.
Well, of course, that's what we try to do with our postcode tool, where we actually look at the individual postcodes and break it down. And we've got some additional sophistication now to be able to look at the difference between units and houses, because they're behaving very differently, right? I mean, generally, my view is that units are really going to struggle over the next 2 or 3 years, even now. And did you notice that the latest projections for population growth in Sydney was it's sort of almost zero over the next couple of years, right? So that's huge, right? We're still building more stuff, but there's no population growth. That's not going to help the unit sector.
Yeah, I mean, and the thing that was saving the unit sector in Sydney, Melbourne and Brisbane, they just did nothing for a long time, and so they didn't really have that boom like in the 2010s that Sydney did, and Sydney did because there was they had the underbuilt. Firstly, then you had foreign investors, you had first home buyers, and houses were more expensive. So a lot of the demand was pushed to apartments because of the unaffordability of houses. And so they were all with the undersupply of apartments, all competing, and they pushed up unit prices. But now there's no investors, there's no foreign investors. And then the first home buyers, we've seen a huge shift. Like the first home buyers that would have bought, that little 1-bed or 2-bed are now buying in Central Coast, north of Wollongong, Sunshine Coast. Like we're seeing a lot of interstate people that were, considering it, that, are from Sydney or they're from Melbourne, etc. And they're thinking about, shifting out. I mean, clients today, they live in inner west of sort of Melbourne, and they're thinking about moving to the Mornington Peninsula, right? Because of, everything. And they wouldn't have done that 6 months ago. I could, bet on that. So, it's very interesting. So those first-time buyers aren't going to buy those apartments. The investors don't want them. Had all the building issues are all out there. So, it's a two-tier market. You've got the apartments, especially the high-density apartments, and then you've got, the houses on good streets in good suburbs that offer livability.
Yeah, and I've done a bit of modelling on that. So in Sydney and Melbourne, I reckon we've got 30 to 50,000 less houses in those sort of inner suburban, the larger, perhaps more established properties. There is more demand than supply, whereas units, I've got several 100,000 more than we have need for, right? And that's because property investors are trying to sell. We're still building more, and the population growth isn't there. And of course, the international students haven't come back, and all those things as well. And we're seeing that in the rental market immediately. So in the inner suburban areas and in the city areas, rentals are dropping like a stone. They're actually not dropping if you move further out. So I was looking today at Frankston and other places sort of further out from Melbourne, and there it's not quite as bad. If you go out a bit further, there's actually quite a lot of demand. So we are seeing this movement between inner and outer. And I've looked out some of the regional areas across New South Wales and Victoria, and there are some very interesting and rather surprising trends between close in and further out. And in fact, the postcode with the highest level of rental stress, is actually Melbourne 3000. I mean, it's huge.
Yeah, I mean, that'll be the same as, Brisbane 4000 and Sydney 2000 and, all these sort of high-rise sort of hells, not heavens, I guess, where there is a massive, lots of cookie-cutter, same apartments. And there are little pockets. There's other little pockets in Melbourne. I mean, not Dandenong, it's Ringwood sort of area. There's a lot of apartments. I think it's Doncaster East and things like that. Box Hill's another one in Melbourne. Even South Yarra's got a lot of apartments. St Kilda Road, around Docklands. There's lots of other pockets. It's not just one area, but usually it's pretty easy to spot. There's just lots of high rises of poorly built apartments. The interesting thing now, we're starting to see a lot of the positive feedback in the media, right? You can flick open the news, market's going to boom, or all the newspapers, the cheaper to buy than rent is starting to come into the commonly you're reading that. So yeah, there's all these sort of things at play as well, which is not going to impact. It's going to impact the rental market, because a lot of those are going to say, well, why don't we buy something? A lot of society pressure, parents, grandparents, friends. If once you start to get this sort of fear of missing out with this positive feedback loop, you're going to see even more problems with the apartment market, I think.
Yeah, I think that's right. And there's an interesting comment here from Jeff, who said flats in inner Melbourne are dropping very fast. 6 months ago, typical 2-bed flat in St Kilda, South Yarra, Richmond was 650k, now 470 to 500k. Yeah, I'm seeing that in my data too. Whereas in areas like Mornington Peninsula, houses are rising. Yeah, I agree with that. That's exactly what we're seeing. And it's consistent. There's a consistent pattern, and we can find the same patterns in areas of Sydney and indeed in Brisbane as well. There is something very interesting and quite disturbing going on. I think units are really going to be in some significant strife. And remember that many of those units are investment properties. And remember that many of those are actually reliant on rents. And I was talking to someone the other day who's got a portfolio of investment properties and has had to discount the rents 20 to 30% to try and get people to come in, and still cannot let those properties. And of course, a vacant property is a real liability.
Yeah, you're right. And a lot of those apartment owners have got 2 or 3. They haven't learned from their first mistake, and they've gone and bought another one, etc. So what they'll probably do is just sit on them if they can. They'll get through this sort of period, and unless they have to sell, then they will. But there's huge impacts on their personal situation long term. It's just these assets just sit there, right? They just, they're not going to make them any money. They're not, probably got negative losses there, and they just have to kind of, find a way to make it work. And low interest rates is going to allow them to do that a lot of the time. But, it's the big ones who might have to go principal and interest, etc. So, yeah, I think it's pretty obvious though with apartments, right? So I think people get the demand and supply there. They know they need to avoid there, but that doesn't mean that that's going to affect house prices just down the road. Even in the same suburb, house prices could be going up, the apartments could be going down. And you'll probably find that in St Kilda. You'll probably find that houses in St Kilda are probably arguably more desirable now than they were post-COVID, and they're probably doing all right. And so you've got 2 different markets in the same suburb. Well,
yeah, you have, and you've probably got some even more complications, because there are people looking to buy houses on a bigger lot and then knock it down and put multiple townhouses or multiple apartments on it, right? So you've got that construction drive as well. So it gets quite complicated. But yeah, in my one-to-one conversations where I actually go into a postcode in detail, I do often see the differential move between units and houses. And it's shockingly different quite often.
Yeah, you get I mean, as a client today, I mean, they've got a house they're thinking about upgrading or renovating, and that's one of the common things that we get. And we had a long conversation around renovating, and unfortunately, they've got a house that's a south-facing block, so that's going to underperform versus a north-facing backyard just because of the livability of that property. And the big thing with this property is it's on a pretty busy road, and so that property is always going to underperform that area, because ultimately the aspirational home buyer doesn't want to live on that road. And so, it's if you're talking about the houses, well, there's three different houses there. You've got north-facing Great Street versus south-facing and busy road, right? And so, even within a suburb, you've got different performance of different houses.
Absolutely. And that is the point. These averages tell you nothing, right? You have to look at individual data points. And at least in New South Wales, you can get individual transaction information. It's more complicated in some other locations these days. And obviously the information on the portals are often delayed, late and partial. So it is quite hard to get good a triangulation point. What I would say is don't necessarily take as gospel what the real estate agent's telling you about what's going on.
No, I mean, there's always a huge amount of bias there in terms of smoke and mirrors. And I mean, we saw it on the weekend. A client was massively underquoted. I said, look, that's not going to go for anywhere near like 1.4. It went for 1.65. And, they got their building in Perth. They were like, no, that's what the agent's telling me. And I was like, no, it's definitely not. And it went super hot at auction and nowhere near it, right? And that's unfortunately the game real estate agents play.
Yeah, and underquoting, of course, is meant to be illegal, but there's quite a lot of evidence that it's going on at the moment.
Yeah, it's always going to go on. It's just the way that the industry works. You're damned if you do, damned if you don't, unfortunately. So if the market believes everyone's underquoting, then you have to underquote, because otherwise your buyers think that it's going to go for 10% more than what you actually quote it for, and so you don't actually get the buyers there. So it's a prolific sort of systemic problem that gets worse in booms because their evidence is 3 months ago. Well, the market's moving in that 3 months, and so they underquote even more.
Now, one other question, Chris, which has come up prior to today, is the question of are agents trying to control the flow of properties coming onto the market? So example was given, you might have 4 or 5 vacant properties in a high rise, but you don't put all of them on the market at the same time. You try and stage it, or a developer does the same. Is there much of that going on, do you think?
I think agents aren't that, flowing with that much work, right? There's not a huge amount of, listings for them to sort of sell, right? And so I don't think many agents are going to be like, oh, don't worry, I don't need that sale. Come back next year. Let's delay this. Let's do it next year. But potentially in some areas where they know they've already got problems selling, they're going to say to that person, so, look, I can't even sell these 5. Well, I can't even just compound my problem. And for anything that, is homogenous and cookie cutter, no agent really wants to sell them anyway. That potentially could happen in that sort of stuff. We know what happens with developers. Developers just, if they can't sell them, they hold the stock and then they slowly just sell one off over the years to get their cash back if they have to.
And one of the other tricks I just wanted to explore a little bit was something which I've got quite strong evidence for now, which is that people are actually transacting on a gross number, but they get a rebate in some way, either to do with stamp duty or just a cash credit after the transaction. So effectively what they're doing is they're selling at this point, but actually the real price is this point, right? But of course that's artificial because the lower price is never reported anywhere. That does seem to be more prevalent now.
Oh, it was going a bit crazy the last few years because the construction industry could see that they were slowing down and they were offering huge cash back on builds, let's say. And I was like, yeah, that's kind of not really, why don't you just give me the build for 200 rather than 250 with 50 grand of cash back of free appliances and things like that. But and then so they can artificially increase the price, etc. But I didn't really hear about it too much happening behind the scenes with developers. And till a client came to us a few weeks ago and said, don't buy off the plan. And then all of a sudden I get a random phone call and said, we've bought this. And then she says, look, we've got can't tell the bank this, but we've got this sort of, secret agreement with the developer to pay the stamp duty. I'm just like, whoa, I didn't even know this existed. and that this was happening. And so, yeah, 100% it's happening. And so it's pretty scary, to be honest, that, there's a side agreement that the bank knows nothing about, that no one knows nothing about.
Yeah, no, we're seeing that coming up in a number of different areas. To do with often with new construction, as you might expect,
Yeah.
but even some older sales are also now being caught up in it in terms of a two-way transaction flow, not all of which is above board, or at least not all of which is disclosed into the public transaction record. So you've still got this high price reported, despite the fact that the true price is 10% lower or whatever it is, right? And that's another example, I think, of where information is being distorted.
Yeah, I mean, developers do it. They don't let you sell, your property pre it actually settling, because they don't want these sort of fire sales where people are like, oh God, I've got to settle in this property in 2 years' time and it's already lost me 50,000. I just need to get out of this contract. And developers sell them to their friends to create a market price, and so then valuers can use that sale to value other things. And there's lots of tricks in this world when you've got something that's, you're going to go bankrupt unless you get rid of your stock. So, and valuation is a huge part of it. And so we do very little in the off the plan space. It's only when clients come to us and they say, look, I've got this and you really help us, and, we like them and so we'll help them. But we stay away from that space because of all the problems.
Well, you mentioned valuations. I've had a few questions. Roro's one that's quite interesting. Are you seeing issues with valuations coming in lower than the purchase price?
We don't really see it because we do a lot of established property so we don't, I've only rarely seen it with established property. When there's a client last year, and bless him, he was highly emotional. It was a big decision to upgrade their home. We've got family and kids and schools, and it was a really stressful thing. And they finally sold their house, and then they had this. They're going to get kicked out. They're going to be homeless, right? Because you've got this 6 weeks. You've got to organise. And they felt like they really needed to buy, and they just went out in the market that next week. And the real estate agents, you've got a writing all over you that you're emotional and that you're desperate. And a real estate agent got on them and encouraged them to make an offer. And all of a sudden, they've made this offer that was way over what it was worth. And then he sent me the contract on Monday. I said, I bought this, and we did a val, and it came in a few $100,000 more. And luckily, he had cooling off and he got out of it. So I just said, look, mate, you've overpaid. But that doesn't usually happen too much on established property. And so we very rarely see it with that, really never. But with off the plan, 100%. And with refinances, it happens all the time. We do a refinance application. We just cross our fingers because we have no idea how the valuer is going to look at that property. You get the super conservative ones. You get ones that are reasonably conservative. And so, vals with refinances are coming in super low. And that's, always the case.
Well, I've certainly seen significant evidence of valuers valuing down the high rise, 15, 18, 20% recently in Sydney and in areas of Melbourne too. And I've had a few examples where people basically thought they committed at one level, then discovered the valuation came in a lot lower, and then had to scrabble around to find additional cash. Tapping into credit cards, for example, or tapping into parents to try and fill the gap. To which my observation was, well, hang on a moment, there's a reason why it's valued down lower, right?
That's right. You're throwing bad money after bad money, right? So it's not going to get, they think that, well, if I get the property, it's going to go all better. Well, actually, the value is probably not being that conservative. They're probably just putting a realistic valuation on it. It's probably only worth 1.2 compared to comparables in the area. And, we saw that one recently. It was a 1.5 and the val came in at 1.2, roundabout a little bit either side. So, it definitely happens prolific really with apartments.
Yeah, absolutely. And there's a two-parter from Chris Paul. He said, on one hand, JobKeeper and JobSeeker have been pushed back. Responsible lending, of course, will also come into play. So with the low rates, won't the market just soar in 2021? And then he came back with a second part of his question, if I can find it further down. Do you believe we are genuinely out of recession, or will we slip back at the end of JobKeeper, JobSeeker? Which is a wonderful sort of combination of all those different factors, trying to figure out, is it going to go up? Is it going to go down? What's your sense, Chris?
I mean, I don't really like try to buy into the whole GDP sort of recession, not recession. I think it's a bit of a, yeah. I mean, there's part of the market that is still doing well financially. There's part of the market potentially doing better financially. And there's a huge pent-up demand of buyers, right, that are more likely to want to take on debt now that rates are, we're getting 5-year fixed rates around 2.2. I mean, the 4-year fixed rates around 1.99, 1.89 at St. George. Like, it's crazy, right? And so if you asked me that 6 months ago, would we see 5-year rates under 2%? I said, no chance. But it's looking like that in the next couple of weeks, we'll start to see that. And so, that's where people are doing their they're in the market and they're going, can I afford the repayments, which is what a lot of people do. And they're basing it on these 2% interest rates. Now, whether they should be doing that or not, this is unfortunately what people will do. Then they'll go to a broker, borrowing capacities higher than they were, rate cuts, tax cuts, changes to assessment rates, changes to the way they look at expenses, etc. So you can borrow more money at cheaper rates. You start missing out at a few auctions, the market's starting to move, and then you start people borrowing more at lower rates. So there's lots of research out there that interest rates have a huge impact on the market. Whenever there's a rate cut, it leads to a repricing of property. As long as the flow of credit there, and as long as consumer confidence, etc. All the reports are sort of saying that as well. So will it be even? Definitely not. Like, it never is even across cities or types of properties. And so, even within the same suburb, the stuff that's compromised, and then we talk about dogs and stars, things that are dogs, they're compromised, whether it's a supply issue or a demand issue, or, the type of property. And so they're not going to underperform, but the stuff that ticks all the boxes, there's just a huge inherent undersupply in a lot of areas that are aspirational. And they're the ones that people are going to compete on and take on more debt. So, it's interesting. You could argue, what's going to happen to the market? It's a bit pointless, but what's going to happen to, tell me a suburb and an area and a type of property, and we can have a conversation about that, because that's more important.
Absolutely. Well, go granular, as we consistently say, you and I, Chris. Go granular, right? You've got to go granular to understand what's going on. Which takes us very nicely to this whole concept of property dogs and property stars, right? And, there is this old adage that a dog is always a dog and a star is always a star. And I've had so many people ask me to try and explain what we're on about. So can you take it from the top? What are we on about when we talk about property dogs, property stars? And can a dog turn into a star, or is a dog always a dog?
Okay, so a dog's always a dog. The reason it's a dog is because it's compromised. There's something flawed about that property that will mean that it'll always underperform. And, everything's back to demand and supply. So is there something about that property that means that it's not that desirable from a demand point of view? We'll start there. So demand is the buyers, like, who wants the property? Like, if it's a studio apartment, who wants a studio apartment? Well, a single. Couples don't really want it. Singles that are doing quite well don't really want it either. So it's just really lower income singles, really, and investors because it's cheap. And so, it's from a demand point of view, it's flawed. It hasn't got enough bigger. If the investor market doesn't want it and singles don't want it, then who wants the property? And so you can go up the type of properties. And so you've got like different buyer pools. You've got couples, young kids, bigger kids. But ultimately from a property, you want an aspirational, someone who's earning good money and really wants to live in that property because it's got livability, etc. And they're earning good incomes. And so if your property doesn't hit that market, then you're really going to be competing on lower incomes or middle incomes. And if they can't borrow the money, then how is it going to push the property price up? So you need to have a property that's super desirable. And if it's not, and by the right buyer pool. So people either got money, so either like someone like a downsizer who's selling out of a house but wants to buy your apartment, because it's got views of the harbour or something like that, right? So, people who have money or people who are earning a lot of money, you need that from a demand point of view. And that can shift over time. So you could buy a property in an area where a lot of higher income, sort of double income families aren't living today. But in 5 years' time, they will be, because then the incomes in that area sort of shift up. And that creates that. Before it was getting bought by people with an average salary of 150. Right now it's getting bought by people with an average salary of 250, right? That suburb's going to shift from a price point of view. The easiest thing to do is think about is supply though. So, can they build more of what you're buying? And if the answer is yes, then to that question, then it's usually going to be a dog, right? Ultimately, can they build more apartments like my apartment? Yes. Okay. Well, I've just got no control over supply. So whenever there's more demand, there's more sort of supply. So that's the second thing that you can really see. But also, like, is the property that scarce? So they might not be able to build any more of them, but is it that desirable and is it scarce? And so the more scarce the property it is, and the more that it provides livability and lifestyle benefits, the better. So if a property is, on a main road, if it's south facing, if it's dark, if it's got, an ugly neighbor, if it's not a weird layout to the property, there's all these things at a property level that impact price as well and growth. But ultimately, the property's priced on, the people who want it and the incomes in that area and who's moving to that area. That's a long ramble to it, but you can easily see that this property, who wants it? Can they build more of them? Ultimately, if you've got a bigger buyer pool over time with a very limited cap supply, and the market's driven by owner occupiers. It's driven by people who want to buy that property because they want to live in that property. And this is where a lot of sort of property bears get a bit confused, because they go, well, how's that property worth $3 million if it rents at $1,000 a week? Well, the reason is people will pay $3 million to own it, to live in it, but not many people really just want to rent it. And so, it doesn't really matter. What you want to do is that it's priced on who people want to buy it to live in it. And so, it's a big sort of misconception.
Yeah, no, very interesting. And, I consistently say that you need to understand the context of the property that you're thinking about, right? The context, in other words, location, amenities, right? How does it compare with others around and about? And also take account of the changing nature of the particular locale that you're in.
Yeah.
That's something which people often fail to do. So, they sort of see it today, but think about what it's going to be like in 5 years' time. Are those other lots going to be all redeveloped, all those sorts of things? It amazes me how short-sighted people often are. And so they miss some of the obvious things when it comes to trying to work out what's a dog and what's a star.
100%. You mentioned it before, Martin. You said that, a suburb could change because they're knocking down houses and they're building duplexes and apartments. Now, if I was looking to buy a property in that area, for me, that's already potentially an area that's going to be a dog from a house point of view. You may make money if you buy a house in that area and you sell it to a developer, but ultimately that area is going to change. The livability of that suburb is going to change. If there's lots more people, lots of development, potentially not that great quality development. So a lot of people think, oh, wow, there's all these townhouses are going up. It's great for the area, but it's not potentially great for your sort of property price. And so, you've got to think about livability today, but what's the livability of that suburb going to be in, say, 5 or 10 years' time? And what's the buyer pool that's going to want it? And that's why the areas that generally perform better have got a very strong NIMBY mentality. And that's when I got cut off last time on this show. Everyone was taking the piss out of NIMBY and all this sort of stuff. But, really, it's the locals doing everything they can to limit development in the area, because they know that if that area changes and shifts and the buy and the demographic, etc., and the cheaper properties get built, it's going to affect the value of their properties. And so those areas are more protected, and they're the areas you probably want to own a property if you want capital growth out of it, obviously. So, it's all about livability, not today, but when you basically sell that property, like, how does that shift over that period? And ideally, a lot of the areas won't shift at all. And that's the idea of an undersupply.
And one of my observations, it's really useful to look at the trend of mix between units and houses in a particular postcode and look at the trajectory over time, because that tells you something about what's going to happen ahead.
Yeah, and the cost of those apartments that are coming on. So the premium suburbs, they're building very little new stock in those areas. They say, oh, there's no more room. We can't build anything because everything's heritage listed and we're going to cut down some trees and, we can't do that. So the only places we can build are these, 10 spots, right? So there's very little new stock comes on. But if they do build, if that apartments that they're building are highly priced, then they're not affecting the price of, the suburbs. So you think about the premium suburbs, they'll build apartments that are actually more expensive than the current apartments. But if you go to a lot of the other suburbs, a lot of the new apartments are just the same price or cheaper than the older apartments. And, you can see how that's going to affect it. So, 100%. You've got to always be looking at the the makeup of that suburb and how's that going to shift over the next 10, 20 years. And it's all out there. You can see where the properties are going to get built over the next 20, 30 years. You throw a satellite, you go onto Google Maps, it's very obvious where there's land available, where there's commercial that can convert to apartments. It's obvious where everything's going to get built. You just got to look at the satellite and have a good look around before you buy, rather than go, oh wow, look at the building around me. You could have seen that if you did that before buying.
Yeah, and you can also visit some suburbs where the development's already happened, and use your imagination to think about what that might look like in your suburb later, right? I mean, I've wandered around some of the inner suburban areas around Sydney quite recently, and it's quite shocking just to see the amount of high-rise like Redfern and a few others around there.
Redfern, yeah.
It's just so different from what it used to be like. And, the fact of the matter is, it has changed the character. The planning regulations got changed, and that allowed, much higher rise development. And you can't go back.
Yeah, so last week a client came to me and, they had a couple of apartments. Neither of them really worked. And they were going to compound the problem and buy another apartment. And, I said, well, yeah, it's a 3-bed. We looked at it. It had views of the city. It was a nice apartment if you looked at the views and things like that. But I was like, well, look at next door. You're literally a couple hundred meters up the road. It's all commercial. This is around the Alexandria sort of pocket. Yes, you got the view. And yes, 3 beds are quite scarce at the moment because developers haven't built them. But if you look at what the developers are going to build over the next 20 years, you've got this big apartment complex. You've got a view, but it's not a great investment with all this new supply that's going to come on. It's not going to stay highly desirable. Buy a house in that area, similar price, to be honest, and get something that's actually scarce. So, yeah, it's interesting where, you just have to really think it through and understand demand and supply. And it's pretty obvious. And that's the thing. It gets frustrating when you see these mistakes, because if you take the time to think who really wants this property, but a lot of people are acting emotionally. A lot of them are going, well, I need to solve my housing problem. I've missed out at a couple of auctions. That's all too hard. I'm just going to go and buy this apartment, or, this busy road, or whatever it might be.
And Chris, the point there is there is always more property.
Yeah, it's good to be patient, right? Like, we had a client literally on the weekend. He got pre-approved. Sends an email to me on Saturday. I want to buy this, this townhouse. We want to make an offer, and I'm like, you're not A, pre-approved, and B, you've been looking for a week. He sent another email on Sunday, sort of saying, I was a bit hot-headed, and we don't want to buy that property anymore. And unfortunately, there's that fear of missing out, which is a little bit rife when you go to a few open homes. A client called me on Tuesday and was telling me about some open homes they went to on the weekend, and the queues and things like that. And this sort of social pressure where you're like, there's a line to buy this house. There's only 3 houses for sale in this suburb right now, and there was 40 people at that open home. That sort of social pressure and creates panic. And so then people just rush out and buy a property because they're worried about, what could happen in the coming months. And that's, unfortunately creates a new suburb sort of mark, and then the new suburb prices of property get priced on that. And so, there's always other property. We had a client buy last Friday, been pre-approved for over 12 months. And I'm super happy that, they learned how to say no, and they said no to a lot of properties. And finally they did get a great property, and, I'm super happy for them because they were super tired and desperate, but they just didn't cave in. They just didn't go for that, overbid a few times. They just walked away from auctions, and you're just patience. You're always another property, and you'll always get something. There is sometimes the ones that got away, but that's just the way it is. If it's not right, just keep going,
Yeah, there's always more stuff. Now, one other question which Master Singleton actually posed was, what's your take on the recent rise in council rates despite the lower valuation for apartments?
I couldn't comment too much. Council rates are different to a suburb level. I mean, if they're basing it on the sort of land value, I can't really comment too much, to be honest. I mean, probably just cheeky. I mean, councils are probably just trying to get as much rates in as they can.
Well, they're pretty desperate, and I've noticed that I survey households and mortgage stress, right? And one of the factors in the stress mix is the rising council rates. right? And it's pretty consistent, pretty much wherever you look, they're going up. And what's interesting is that rentals and incomes are flat or falling, right, in real terms. So these council rates are becoming a bigger question for many people. And it's quite interesting that, when you actually add up all the amount that people have to pay, it gets quite significant. I'm not sure to what extent it's directly linked to the price of property. I think it's more linked to the land value in a particular area. There are some big changes, of course, in land values, both up and down at the moment. If you look over in Western Sydney, plots are in some cases half the price they were 2 or 3 years ago. If you look close into the city, some of the plots are actually going up still because there's significant demand. So it depends where you are, I think. So it's quite a complex set of relationships. But generally, mortgage stress is highlighting that this whole issue of council rates is a significant one, and many people are struggling with them.
I think the interesting thing around council rates is if you're in an area or council that wants more rates and they're willing to approve more things to get those rates, you're probably in the wrong council. So, you don't really want to be in own property in areas where they're just approving everything. You might, if you potentially have got a big plot of land and you're, foresight, you saw that there was going to be this zoning change and you bought a unit block that you could knock down, you can sell to a developer or something like that. Like, there is money to be made there, but if you're looking for something to buy and hold, or you're looking just at, then they're the wrong councils to be sort of owning property. You want the councils that are approving very little and there's, riots if something's going to get knocked down. That's it's a different world.
Going back to NIMBY, very important factor. Maybe we should create a map, a NIMBY map, right? What's the suburbs where there is most resistance to change, because that might tell us something about future property values.
Yeah, there's definitely be a correlation.
Now, here's an interesting one. Otto Con said, Chris, throwing bad money after bad money, that's the definition of the housing market at the moment. I thought that's an interesting observation.
Yeah, I think it's there's two sides to it, I guess. Like, if you you look at sort of low rates, right, and it's going to encourage more sort of demand, and the cost of taking on that additional debt is, let's say, 2%. The people who do sort of upgrade potentially in this market, and this, everyone think, he's just trying to spruik more debt, but ultimately, if rates are very low and you can create more demand, you create more transactions, for the good houses, you're probably going to see there's going to be, growth more than, say, 2%, let's say, on that debt. So, within, just taking on sort of, a finite sort of way of it. But, if you're just sort of buying properties or you're, just accumulating properties, even though low rates, you may be able to afford the property from a cash flow point of view. And that's the thing, a mistake a lot of investors make is they go and buy properties that are high yielding. We had a client that bought a property today in Parks in New South Wales, and he's like, it's got great cash flow and it's positive and things like that. And I'm like, well, what are you actually making on this property? And, thinking about the maintenance and things like that. And then you've got to pay tax on it. And so, low rates are fine keep the cash flow going, but it all comes down to the capital value. Is that paying that interest worth it from a capital value point of view? And most people don't think about it like that. They just buy a property because they want to live in it. And they say, it doesn't matter how it performs because it's my home. But it does matter, because ultimately you sell that property one day and you take those proceeds and you do something else with it. And so it really does matter how your property does perform, and even if it is your home.
Yeah, absolutely. Now, there's a couple of people asking about liar loans. In other words, people telling porkies on the way in. I guess as a mortgage broker, that puts you in quite an interesting position. To what extent do you have to validate the information that they actually are providing to you, and to what extent do you pass that back to the bank?
100%. They don't really exist. Like, it's not like these ninja loans where the bank verify income. Like, it's in their interest to know that you're actually working, that there is. So the most important element to a mortgage application is your income, and the bank will verify that, and they'll also do a credit check on you. It's crazy how many credit check problems. We haven't really seen them. But just recently, we're seeing this proliferation where people are just not managing their credit file. So they're, and the banks know everything about undisclosed debts. They just do a credit check and it's all there. So I don't think it's really that prolific. And there's all these liar loans. The only thing where people potentially is a bit hazy around is living expenses. And this is where this whole APRA versus Westpac case The banks were thinking about doing forensically looking at it. That's where the problem is around, and that's where the ASIC and the responsible lending is coming into it, is around that part of someone's situation, is their spending. Because that's where you can lie. You can say I only spend $5,000 a month, and if the bank doesn't look at your expenses and you're spending 15, then that's obviously a lie. So that's where the problem is. It's not around income, because the bank will definitely want to see pay slips. It will be super nervous. We'll know everything about that. So it's not really. I don't think it really exists.
Interesting. And the fact of the matter is, a bank is interested in just one thing: can you go on paying and paying and paying each month, right? That's what they're really, because basically, you as a household, you as an individual, you are a set of future cash flows. That's how they think about it, right? And
I think so in the past. I think the second element to that is now they also potentially care what you're buying. I think that there's going to be even more sort of selective a customer. And is your behavior in the past potentially going to create you as a high risk customer? I do think that banks are going to become more selective in terms of who they want on their books, and we saw that definitely in 2018. But if you think about this sort of market where they're like, well, yeah, we could keep lending this money, but we don't really want to be doing in these postcodes. We don't want to be doing these apartments. They'll just create their credit policy and be super targeted and niche. You saw Macquarie come out this week with a new marketing campaign, and we're the place for good home loan customers. And we do a lot with Macquarie. We love Macquarie, but that it was interesting that they're targeting people that are great on their mortgage, that are etc. So yeah, I think you're going to find that as well, where banks are a little bit they look at your application, look at what you're trying to buy, and then ultimately make a decision on that a little bit more than just can you afford it.
Yeah, and I have to say, Chris, I do know of cases where untruths were told through the chain between the prospective borrower, the mortgage broker, and the bank. And in some cases, they got a loan they should probably have never got. I mean, the Royal Commission threw out a few of those too. It clearly does exist. It's just a question of how much. And UBS came out with some, amazingly bad numbers in terms of liar loans. I have to say, we haven't seen the consequences of those in terms of defaults and failures. So maybe they're overstating the situation. But I know at the margin, there are situations where people probably get loans that they should never got in the first place.
Potentially. Like, I think around the income, you might have found if it's a bit of an automated sort of approval thing. But I just think the credit assessor at the bank ultimately has to sign off that they've, ticked all their boxes and, the major things around income. I mean, if the pay slips are dodgy, right, and they're like, that's just fraud and, etc. And if there's the parents own a business and they're paying someone or there's something like that, I'm sure they do exist. But for the majority of people out there that aren't sort of faking pay slips, which is fraud and you go to jail and all that sort of stuff, I don't think it's that prolific. I just don't think the banks are that ignorant. They're not just approving things that, they're following guidelines. Maybe I've got too much confidence, but it's what we definitely see. And I just think mortgage brokers wouldn't do it. It's a pretty short-term business model to a dodgy loan. Your license will be gone and everything you're trying to build for your career is gone as well. So I just don't think it's there.
Okay, well, interesting. Thank you for that. Now, one of the interesting questions I wanted to touch on was renovations, right? There has been a bit of a renovation boom in recent times, and I wondered what your perspective on that was, and particularly whether people are drawing down additional equity from their current property to be able to cover the cost of renovations.
Yeah, 100%. There's a massive boom on it. People are spending more time with their home. Rates are low. And so that allows them to afford the additional repayments on the renovation. And they also don't have the confidence or the ability to sort of do an upgrade, whether it's their income or they don't want to take on that extra debt to do the pay stamp duty and selling costs. Also the stress, low listings is making people go, well, there's not actually any properties that I do want to buy. So why would I sell? Haven't seen anything in a hot market. People are like, oh, wow, I've always wanted to live in that street. I've got to sell my apartment, my whatever it is, and so I can get into that street. So low listings create that. 100%. We're seeing they if they're sort of cosmetic sort of thing, most people will just refinance up to 80% or at least, 50, 100,000 to do the reno. If it's the big sort of construction, knocking down walls, adding levels, etc., you've got to do a construction loan unless you're super cashed up. And so they're going to the bank and it's, getting DAs and fixed price contracts, etc.
Yeah. And, I still see a number of redraws where that money is being sucked out specifically for restructuring and renovations, and so the equity is being chewed away. And I wonder whether sometimes people do that thinking, well, of course, property prices are always going to rise, so not a problem, right? I don't know what your perspective, Chris, is with regard to future property price movements. I was seeing a couple of people on the chat saying, they're going to go to the moon, right? I'm not so convinced that even with those really low interest rates, we're going to see that same acceleration that we saw a few years ago. So I think people need to be a little bit cautious about chewing into their equity just to service a bit of renovation.
I think there's two types of renovations. There's, ones that really don't add any value. You're just doing it because you bored, or you're not really sure, or you're completely butchering a property. We've seen those before where they shouldn't have renovated it. But a lot of the time, because the person, if you ever had to sell that property, it's much easier to sell a renovated property than something that's not renovated. The reason is you've got more buyers that would want that property. Everyone would want that property if they could. But a lot of the buyers can't afford to buy it and do the renovation, but they can borrow 90% on it or 85% on it. And so, it's much easier to sell the renovated property. So I would say that if you did, if rates are low and you can afford the additional repayments and you want to spend $50,000 on a renovation, it's going to add $50,000, $100,000 to the capital value. Personally, and you get to live in that property. There's no point doing it just before you sell it. If you might as well get all the lifestyle benefits. And that's why low rates make that more affordable. 2% over, say, 5 years isn't a huge cash flow expense to do that renovation. Whether if it was 5%, which was potentially just 2 years ago, rates were around 5%. So it's pretty crazy where they are.
Absolutely, that's true. Now, the other question I wanted to touch on before we finish up, migration. I mean, migration, of course, has driven the market for a long, long time. We have the international borders shut at the moment. The forward projections in the budget are a net negative migration from Australia over the next couple of years. And as I mentioned earlier on, Sydney is basically saying we're not going to see any population growth over the next year or so. To what extent do you think this is going to fundamentally change the market ahead, or is it just a marginal question?
So I think there's short term, no migration. When does it come back? It's going to come back at some point, right? How much it comes back, who knows, right? So I think where's that going to affect? It's going to affect the apartment market. It's going to affect the international students. You can already see AFR, we're talking about it today, how much of an impact that is happening to the sort of New South Wales economy, let's say. But international students are going to come back at some point. We're going to, and it's one of the tickets that the Australian government have got. Is Australia more desirable than what it was pre-COVID compared to other sort of countries around the world? Well, I'd probably argue yes, if the unemployment and the sort of economy sort of is back going again. So, I don't think long-term it's going to be this. We're not going to get migration. I'd say arguably we're going to get more migration, and it's up to it's whether the government attempted to sort of change the rules around it and let more people in, etc. So, I think the migration thing is there will be this sort of lag where, a few years down the line, the people who didn't move here in 2020 when they got work, etc. So in 2023, there'll probably be a bit less demand than the people who would have bought here, moved here in 2020. So ultimately there's probably a little bit of a dip, but I don't think it's a big problem. I think it's a big problem if you've got something that a lot of the new migrants would buy. A lot of the outskirts, sort of house and land packages, a lot of the new apartments, if you've got an apartment near a university and you've got no international students, 100%, you're going to be affected. But does that affect houses on good streets if there's no migration for a couple of years? I don't think so. There's enough internal migration. There's enough demographics. And that's the thing. People don't realise that there's always demand building because people are moving and they're having families, and their needs is changing. And so the demographics of Australia is still really strong. And so I don't think if we don't have extra couple 100,000 people for a year, it's going to change things dramatically.
Okay, very interesting. And, I've had very different arguments for and against the impact of migration. But I think your point about there is that natural drift, as people age and create families and all those sorts of things. What I'm interested in is towards the top end. So what about the baby boomers and above who have got the larger properties and are now getting to the, perhaps stage in their life where they want smaller, when they're going to need to sell? And to what extent have we got enough people coming up below to be able to mop up some of that larger property that's going to come on the market? I think that's probably the most significant demographic shift that I'm seeing in my modelling.
Yeah, I mean, if you speak to a lot of older sort of retirees, we don't do very little in this space, but for the first, 5-6 years of financial advice, all my clients were 60s, 70s, etc. Most don't want to leave their homes. They've lived there for 10, 20 years, and so they'll do everything they can to stay in that home, and they'll do modifications, etc. One of the interesting things with responsible lending, the government have done it as well, reverse mortgages, and, you could easily see some rules change around that. And so the kids don't really want to sometimes get them out of the home as well because they know that's their inheritance. And so they're enticed to keep them in the property. So, it just doesn't happen. So you just see these people are living a lot longer than people expect, especially if they're a couple, one surviving and then they stay in the property, etc. So, they don't just all of a sudden yes, they're coming onto the market. You get these deceased estates, but it's happening a lot slower than people expect. And ultimately, people just want to stay in the homes. I think the government wants that as well. So, I think people don't. The downsides don't, especially after COVID, right? Like, if you've been in there, that generation's hit harder than other generations. Potentially, have been a bit more worried that if they got COVID, it would have health impacts. And they'd probably be thinking, luckily, that I'm in a house and I'm not living in an apartment block. And so that sort of emotional impact is going to make them say, well, actually, you know what? I don't want to move into an apartment block, and because they wouldn't have wanted to be in an apartment block over this sort of year. And so I think that's going to slow down the downsizers, rushing to move into apartments as well.
Yeah, interesting. Somebody's asked there about auction clearance rates. The numbers look to be going up, although actually the total volume isn't huge. What's your read on what's going on with clearance rates?
So you have to go to the suburb level, which we've probably said 50 times, but then you also have to go in that suburb and look at the type of properties that you want to buy to actually know what the clearance rate is, because you could see 100% clearance rates for houses on good streets in that suburb, but you could see 60% clearance rates for things that are compromised, whether it's dark or poor roads, etc. The good barometer is the poor properties. If they're selling, not the hot properties, because they're always going to sell. That's a good indicator of what's happening in that suburb, how desperate are people. So if you go to an auction, it's not a great property, but it's still going super hot, that to me is interesting. And that's when you get the interest clearance rates at 80, 90%. That means everything's selling, no matter how poor it is. If auction clearance rates are at 60, 70%, it shows 60, 70% of the properties are good properties that are still selling, and 30, 40% of the compromised ones that aren't selling. Obviously, there's severe sort of drops when confidence is, like when COVID was really kicking off in, sort of March, April, you saw clearance rates fall off a cliff because, no one wanted to buy and et cetera. So, but yeah, I don't really try to read too much into them. Ultimately, it's going to those auctions and going to open homes where you'll actually start to really understand what's happening in that market. And it can be completely different across the capital city. And, you can see everyone quotes the Sydney clearance rate. Well, what does that matter to you? What is the Northern Beaches? What is the Inner West? What is the, and that's what you really want to be sort of understanding. Try not to fall for these sort of big sort of headline numbers.
There's a few people spruiking them, of course, but that's a whole another agenda, right? Which isn't necessarily connected to what's really going on the ground. And, for the nth time plus one tonight, go granular, look what's happening locally. That's the only way to understand what's really happening with the market. You cannot look just high level. It doesn't make any sense.
Yeah, I don't even look at it, to be honest. Like, I'll look at the auction results, but I actually, when I'm scrolling through my phone on Saturday night and seeing what's sold, I don't even look at the rate. Like, the data is just so poor. Like, for me, it's just a pointless number. But what I will do is look at certain suburbs and go, actually, that looks like a decent property. It looks like a pretty good price. Look at that. That didn't sell. I wonder. You can actually learn a lot by going through what's actually has sold and what hasn't sold, and just start to think through, why do you think that hasn't sold? Like, you got to love property to do that, but you'll learn a lot by watching those sort of things.
Absolutely. Well, I find those the one-to-ones that I do when I have to go and research a particular postcode, I find it really fascinating, because the more you sort of peel back the onion, the more you realize that there's a bunch of dynamics going on which is different from that over there and that over there, right? And actually it gets quite compelling, I have to say. I've done a lot of them now, and learned a lot from the conversations.
It's like, where does the locals want to be in that suburb, right? Like, you don't really know. When you're buying these suburbs, a lot of the time you're like, oh, actually, wouldn't it be nice to live on that street? But you didn't even know that street existed, because there was no properties for sale on that street when you were looking. And because they just turn over that infrequent, because no one wants to leave that street because they know it's the best street in the area, right? And so, and that's the thing. When those properties in those streets start to come on, you've got the locals wanting to upgrade, you've got new buyers, etc. And so, what the locals really want, what they don't want, is a really good indication of where to avoid. And you need to get on the ground, you need to be asking questions. Sometimes it's what you want, sometimes not what the local wants. And that's a really big sort of thing to know, because you could be heading down the wrong path. When you sell that property 5 years later, you're like, why isn't no one rocking up? Well, it's got a really steep driveway, or it's backing onto a swamp that no one wants to be near, that you just didn't know.
Yeah, absolutely. Yeah, okay, last little section, then we'll close off, Chris. The government has done a lot, right? So through the Reserve Bank, they've taken interest rates down really low. The government has used various schemes to try and persuade first-time buyers to buy homeland packages, the renovations schemes, etc., etc. So almost wherever you look, the government's been supporting the housing sector. My question to you is, do you think they're going to do more?
Yeah, 100%. Like, I think Home Builder 2.0 is coming. The 10,000 places was an interesting one. I think they realised it wasn't working how they wanted it to work. And you're getting a lot of the first-home buyers were using it to buy established property, not buy new property, which doesn't really make them that much money. And so they're like, well, let's not keep doing this. This is, people are a bit switched on. They want them to buy the new stuff. So Home Builder is much more successful. And they're trying to do the 10,000 place to new properties, and no one really wants it. So that's quite interesting. They could do a lot at a sort of bigger level, tax cuts, infrastructure, etc. Do they make changes to stamp duty? Do they make changes, bigger incentives, for first-time buyers? Like, you could buy up to $1 million without any stamp duty, etc. So who knows what they've got up their kitty? Because, I didn't think they had responsible lending up there. I didn't think there'd be mortgage holidays. So I got no idea what the government's thinking, but I'm sure they're thinking, what ways can we, encourage people to take on more debt, support the house prices? Ultimately, they want prices to keep going up. We all know lots of reasons, the tax revenue, in many different ways, the council rates you were talking about before. But ultimately, if that's their biggest asset, people feel wealthier, they can afford the cash flow, they'll spend. We're a consumption nation, and that'll probably, create more jobs. So that's the only ticket they know. They don't really know anything else, right? They're not an innovating sort of government that is investing in lots of job creation. They're like, invest in house prices and hope that we spend money.
Yes. Well, we often said that property sector and the finance to underpin it basically has driven the whole of the economy for a generation plus. Strong migration helped. There was a bit of mining over there, that's a few exports to China, which helped as well. But really, the whole economic structure of the economy is based on housing, high debt, high house prices, high gearing, high leverage, large bank balance sheets. And the worry, of course, for the government and for the financial regulators was, if that falls the other way, then that's going to be very, very serious. So they're going to do absolutely everything they can. And I guess the question, which is always why I run scenarios, right? Because I can argue there is a scenario where that works, and we do see house prices continue to drift a little higher over the next 2 or 3 years. I can also see some scenarios where things go a bit more pear-shaped and it doesn't really get to where they want to get to. So that's one of the reasons why I talk about scenarios rather than a specific, end point. But it's clear to me that they're going to do more. Home Builder, they'll probably even do even more to try and support people with existing mortgages if they need to. They will do whatever it takes.
Yeah, that's what that CBA thing came out this week, moratorium. I was like, well, I didn't even know that could possibly happen. And so, there's all these things that'll just keep on happening. The banks will just to keep the banks off, keep people taking out mortgages, keeping, low rates, etc. Ultimately, that's why I think they'll just go to the migration. Like you said, that when they move here, I was reading today, a university student, brings in $50,000 into the economy per year. So it's, are they going to just try to encourage that? Are they going to try to encourage, skilled migrants? I think that's the ticket they'll go down, to get a lot of more people here and spending money.
Hong Kong?
Yeah, exactly. I mean, you've got people moving back. We've had a lot of expats actually come back to Australia that are thinking about buying here in, they're not coming back right now because they can't, but they know that, ultimately their views have changed about living overseas, whether it's London, Singapore, Hong Kong. We've had people in Dubai as well. So, a lot of people are saying, well, you know what, I kind of miss home. It's been a tough year. I wouldn't mind coming back. And so I think you're going to see a lot of that as well. And also does that, professional that wants that international experience, do they want it as much as they did if they know that there's a global recession or other countries are, etc. So maybe you won't see that, sort of leakage or the brain drain as much as you did before.
Okay, thanks for that, Chris. Okay, two quick ones just to finish off then. Do I buy the best house in the worst street or the worst house in the best street?
The worst house in the best street. Ultimately, what you want to buy is land. So the worst house, though, probably isn't mean you should buy it, because if it's the worst house, it could be something horrible about it, right? So you don't want to buy the bottom end of the market. But if it's a good street, ultimately, if you're buying, most of your money's going into the land. If it's the worst house, hopefully you can knock it down. And so you're buying, ideally at land value, and then you just build a house on it. And so that's why you'd buy the worst house in the best street, because ultimately that your land value is what you're buying, and land's what goes up, not the building. Rather than the best house in the worst street. So most of your money's going into the house. And the house is what depreciates. The worst street, your land value is not going up. So you got this beautiful house and everyone's like, oh, look at that house. But you're buying the top of the market as well. So, yeah.
Okay. And then the other sort of part of it is one story or two story, which is better?
I would say one story, just because, stairs aren't that fun, and I think you got a bigger buyer pool like downsizers. If the floor plan's good, one story where it's all really tight, potentially not. You might go for the two story if you've got that sort of bigger. Also, if you can build up on a one story. I think the thing people need to remember with the street as well, we had a client compare two properties on the phone, might have been yesterday, etc. But he's like, what do you think, this one or this one? And I was saying, well, yeah, it's a much bigger lot of land, but it's south facing, and you can look on Google Maps and Street View and you can see all those trees, right? That's all your sun gone. Like already south facing, you've got these trees. So you're not going to see, and so it's just things like that you just got to be watching out for. But I'd go one story over two story if it was me, but I live in a multi-story house, so I'm a bit of a hypocrite.
Yeah, indeed. Well, Chris, I found that fascinating. Thank you. We've covered a whole range of things from your list. We haven't covered everything, but we've actually done a pretty good job. Is there anything else that you want to highlight before we finish tonight?
No, I'm sure a lot of you people have gone to bed, so I'm comfortable with that, Martin. Appreciate the chat.
No, well, thank you very much. I can tell you that we've had a good range of chats on the live stream as well. I really appreciate your insights, because you're there on the ground, seeing it, day in, day out. And I think, as we keep saying, granularity is key. And the realism that comes from that, I think, is pretty critical. So, Chris, thank you very much for spending your evening with us. We really appreciate that. I'm just going to sign off on the overall show. So let me just do that, and I'll come back to you just finally. So I want to just say thanks to everybody for spending time with us tonight. Just to let you know that next week we're going to be talking about investing in an uncertain world, and I'll have some guests on specifically to talk about that. And you may like to know that for those following the channel, that I'm talking to Peter Schiff tomorrow morning. So I'm going to get his perspective on investing in an uncertain world, and that's going to be a theme over the next couple of weeks, because I do think this is probably one of the most critical discussions to have at the moment. So watch this space. So Chris, many thanks for your spending the time with us this evening. I really have appreciated it. And do come back and have another go later on. There's always plenty of stuff we can talk about on property, because what we know is that by next time we chat, it'll be different again.
Yeah, and who knows what the government does. So, yeah, look forward to the next chat, Martin.
Okay.
Cheers.
Great. Cheers. Take care.
Bye.
So there we go. And I want to say thank you very much for everybody who's watching the show tonight. Do share, do like, and come back and talk to us some more next week. This is Martin North from Digital Finance Analytics, signing off.